Good morning, everyone. I'm Vince Lancy. It's Tuesday, 7:45 in the AM. Big day yesterday. We're going to look forward for the most part today. So uh, let's go to it. There's the front page. We'll be talking about the story in the lower right-hand corner there. The silver squeeze has yet to begin officially. That's our opinion, and we'll explain why in a second. Uh, for now, let's take care of the markets first. 10-year yields are 4.11 up 2. The dollar is 99.42 up 2. The S&P 500 is up 13 at 68.28. The Nasdaq is up 68, 25, 418. The VIX is 1685 down 40 basis points. Gold is 42.04 up, I'm sorry, wishful thinking. Down 26 was lower. Silver 57.28 down 67 was lower. Copper 517 unchanged bid. WTI down 34, trapped in a trend line wedge lower now. Natural gas 474. Wow, up 7 cents. The drive for five in natural gas, folks. Natural gas. Bitcoin, it's 87,300, bouncing off its lows again, but seemingly captured with some trapped selling above. Ethereum 2821, up 80, 85 basis points. Platinum, palladium violently mixed. Palladium up 11, platinum down 35, 1436 and 1623 respectively. Gold, silver 73 and change, up a little bit today after yesterday's crushing. Um, Grains are mixed. Soybeans up 50 basis points. Corn is up 10 basis points, and wheat is down. So maybe that's grain specific, planting and harvesting and all those other things that I don't understand, but I try to. Okay, before we get started, featured posts. We had some posts that were featured on other people's sites. Scottsdale Mint, Zero Hedge, Yahoo, and JPost. The links are all there. We'd appreciate it. They would appreciate it if you would access those. Those are full premium stories that we've put out there. So, um, where were we? Okay. The silver squeeze has yet to begin, really. The global silver market is tightening into a slow motion short squeeze as physical supply vanishes, demand accelerates, and financial engineering replaces metal delivery, real metal delivery. Now, that sentence there, it sounds like something like, yeah, we knew that, right? But understand that when an industry or a person is under stress, they do what they've done before, just more. And so I don't really see, at least on the surface, to the extent that I can, uh, the shorts in silver doing anything but delaying it more. And I'll say a little bit more about that. Silver's squeeze, in our opinion, hasn't started yet, but the setup is in place. So physical supply is vanished. These are things we all know, but just put them all together. Physical supply in London is vanishing, right? While industrial demand, ETFs, and BRICS buying accelerate. Bullion banks are still rolling futures to defer delivery, turning a metal shortage into a balance sheet uh, financialization potential problem, right? I mean, there's some big deliveries being taken. That's the word, but they're not all being taken. Some of them are being rolled. Look at how the open interest is rolling. Drops in one month and goes up in another. They're kicking the can down the road. I'm not saying that's a bad thing. Well, it is a bad thing, but I'm saying that that's when you're uh, look, when your back's against the wall, you do what you've done to survive. And I think having been in that situation, uh, I think they're just doing what they do because there's nothing else they can do. I'll give you an example. Um, uh, when you look at what's going on around silver, China pre-sold upstream supply. Silver cannot be leased like gold. Okay, Eric Young and I have discussed that, but that's something Eric really focused on a couple months ago, and that's, you know what, central banks have gold to lease to people who need it. They don't have silver above ground. So that's I remember what Eric says. That's really good insight. So anyway, um, Comex deliveries keep pulling metal flow from an already depleted pool, right? Yesterday's price action, I should say, reflects financial stalling, not real capitulation. The real event comes when funding fails or a counterparty breaks. Until then, stress builds quietly beneath the surface, not so quietly lately, and the clock keeps ticking towards a physical repricing. Look, the point being is if I'm a short of serious financial means, I have a lot of access to capital and serious physical market connections, and I can't get my physical anymore, well, I have two choices. I could default and say I don't have the silver, and I'm not going to do that because it would jeopardize my firm, which is much bigger than my little silver division. Uh, or I could do what I've been doing, and that's double down. That's the martingale, right? All right, roll it. Hope they don't take delivery. If they take delivery, give them what they can and roll the rest. Keep deferring it. In a sense, they're financializing, well, not in a sense, they're financializing the physical by rolling the shorts. And it's not just rolling the shorts. When you get into the physical delivery moments, someone will say, I want delivery. And if you're the short that has to make delivery, because that's what happens, well, then you call them up if you can't make delivery and you say, listen, I can't make it. Can you delay for 30 days? And they say, sure. They say sure, they say no. If they say sure, then you guys do an OTC trade. You roll from, let's say, Novi to Dece in futures, and you see the open interest change the next day without a real trade going on. And you say, okay, what happened there? Well, what happened there is uh, the short negotiated with the one who wanted delivery and said, look, if you wait 30 days, I'll have it for you. It's a check is in the mail type of thing. And you keep doing that, but you have to incentivize them on that. It's maybe you give them a free toaster. Who knows? But the point is it's you cajole, you prod, you get people to roll. Now, with the hopes that as time goes on, because they're buying time, the problem corrects itself and then someone changes their mind. It's like, I want to buy gold, it's going up, and then it goes down and then you say, oh, I'm not going to buy it, it's cheaper. That's the same mentality, right? So they're testing to see how real the demand is. It's really significant. That's what you do when your back's against the wall. You say, dude, would you mind rolling it? And the guy's going to say, I'll roll two-thirds of it, and that just keeps happening and happening and happening. And the problem comes if the bank gets to slowly cover his shorts over the next 3 or 4 months, but he covers them with some idiot fund that gets short. Oh, I'm bearish, right? Well, and then the market goes up, and then delivery gets taken again, and the one who wants to take delivery isn't a big bank. I'm sorry, isn't taking it from a big bank. They're taking it from a small hedge fund, and then you have a counterparty blow up. Boom, right? So just to bring it all back to um, English. They're rolling and deferring delivery with the hopes that either the metal will come up or the delivery will go away. They won't need to do it, right? And in doing that, they are taking physical risk and fully financializing it. In a sense, it's a cash settlement, right? You keep cash settling until the metal's truly needed. And that's where we are now. We're not even it's not a short squeeze yet. And here's why I feel that way. The lease rates, which spiked last time, everybody was all over that. Bloomberg, Reuters, the lease rates are up, the lease rates are up. Lease rates aren't up this time. Okay. And lease rates aren't up this time because there is no metal to be leased. So you're just not going to lease it. Uh, we're not going to ask. Anyway, um, I think we're I think we're I think we're just getting started, and that means you could have dollar swings either way. So, and there's other things I want to talk about later on in this little chat here. Anyway, news and analysis. There's the 4 stories that we put out yesterday. And in case you missed it, the data on deck is Tuesday auto sales, right? ADP, PMI, trade deficit, PCE. Okay. There is one other thing. Oh, I'm sorry. I forgot. There's a very cool chart I want to show you. Where is that chart? There it is. All right. So today, about 10 a.m., we're sending out a story. Crypto's growing interest in gold and now silver, and that publishes at 10 a.m. The link is there if you want to bookmark that. But that story is going out in email, but it's not big enough on the screen. But see this chart here? It's a very cool chart. It's a Bloomberg chart, and it shows if you can, if you can zoom in on it. I can't zoom in right now. If you can zoom in on it, what you'll see is you'll see the lower chart is gold. Gold has made an inflation adjusted all-time high. So that's 1980 here. It's too small. So here's 1980 gold, and here's gold today. So it's eclipsed its inflation adjusted high. Silver is nowhere near it. It hasn't even gotten above its 2011 inflation adjusted high. CPI adjusted, not necessarily real inflation. So if you want silver to get to its inflation adjusted high of 1980, it would have to trade $150. So there's your target. It's a good target, I think. Uh, Not tomorrow, but over time. All right. Uh, there's the oil chart. I'm looking at oil and I'm saying this is a market being managed. I mean, I don't mean manipulated. I mean, this is a market with a lot of selling that's coming into it in an orderly fashion. I don't think they're worried about panicking the market. I think you've got the whole OPEC, US conversation going on, probably affecting things. Uh, Gold, right? I mean, what can you say? You've got a channel here within a bigger channel. We've talked about this. Silver. Yeah, I mean, I think pullbacks should be bought, depending on how deep your pockets are, right? Pullbacks can be bought as low as 54 and a half. Okay. Uh, but I'm not saying that I would do that. I'm not going to buy a pullback to 54 and a half. Why? Because I'm already long under 54 and a half for this speculative trade that I have. And so therefore, I'm not going to buy it again. But if you're looking for an entry, you would have to look for a pullback that gets near but doesn't violate 54 and a half. Or you could buy it here and go to an hourly chart and say, well, let me see. I'll buy it here, and as long as it doesn't get below 53.70, that's crazy. That's absolutely crazy. For like $4 in 3 days. I mean, it just blows me away. Um, Now you're looking at this, I guess. I guess you're saying there's got to be buying in the 56 and a half area. And if you're bearish, if it cracks it, you think it's going to go to 53, 54 and a half, right? If you're bullish, if it gets near it, you buy it. So yeah, I like this. Here we go. Here's a range. This is a market that's digesting the movement to see if it's real. Here's a bigger range where you have real buying here and you have real selling here. This real selling hasn't been tested much yet, but this real buying has. So uh, unless we break below 56.50, you would look for this to be retested uh, in the next, say, 72 hours. Yeah, that's a spec trade. I mean, you want to risk $1 in silver? You might have to these days. The market's very volatile. Uh, Long at 50, 57.45 with a stop loss below 56.50. Conversely, bearish, you sell weakness below 56.50, you reverse, right? Or you wait for it to get up here and you sell it and you stop yourself out up here because now you're really bearish and you're saying, I think the market can go all the way down to here. That's it. Those are your trades. Structure within a structure within a structure. And you can do your trend lines and do all that stuff too. But that's how I'm looking at it today. And if you're wondering why gold and silver are climbing now, well, this is the American prop desks getting ready to say, oh boy, here we go. They're going to buy gold and silver again. They've got the order flow on their desk. It's the nightclub that hasn't opened. It opens at 9:30 and they're stocking up. They're getting ready for the big rush. And that's why they're buying it. And who knows, maybe the buying doesn't materialize and they go, "Oh shit, I have to puke." But generally speaking, they don't speculate. I've had a conversation with a metals industry executive yesterday. Um, and we were talking about several things, and I haven't even shared this with him yet because it's a new conclusion. There is something going on underneath the surface. There's always something going on underneath the surface, but I'm talking about financial statecraft. I'm talking about well, the conversation was about how the industry is ramping up in certain ways, and how there's legislation behind the scenes, 401(k)s and what have you, and 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 how his whole industry is also ramping up for something else. And maybe he knows and he can't tell me, but uh, here's what I walked into that with, and I'll tell you what I walked out of. It's something I'm going to develop, I think, a little bit further. But look, the U.S. faces two simultaneous pressures, big pressures, geopolitical pressures. Protect the dollar and domestic capital pools. That means keep assets under U.S. regulatory jurisdiction, keep savings circulating through U.S. markets, not offshore or into informal alternatives, not in the system, right? Okay. But at the same time, they have to adapt or adopt, depending on how you look at it, to rising demand for non-fiat stores of value, retail and institutional demand for gold, silver, and now crypto. They can't be legislated away, and attempts at repression historically fail. I mean, they work for years, they work for decades in gold. So demand either migrates offshore or into gray markets. So when capital wants something that policy disapproves of, governments have two options always. One, prohibit it and risk capital flight, which means you prohibit it and you create capital controls, or accommodation via financialization. So supervision and taxation. The US has almost always chosen the second path. Now, the examples that I think everyone here is familiar with is, some people are familiar with, is when gold went from when they created a futures contract in gold in 74. That's financialization. Capture the order flow, tax the order flow. Uh, and then when the ETF was created, capture it further. Same thing with Bitcoin, right? Bitcoin, you had a futures-based ETF, right? Grayscale, whatever the hell, Graystroke, who knows what they're called? I don't care about them. And then you have the actual spot ETF. So it's capital that when something risks competing with the dollar as global reserve currency, you've got to protect the dollar. But you can't deny people their demand or they'll go somewhere else. So when capital wants an outside asset, turn it into an inside security, right? That approach neutralizes monetary competition, prevents offshore capital escape, keeps financial flows taxable and observable, and strengthens domestic market dominance. Strengthens domestic market dominance, which projects out for a global reserve currency. Gold ETFs and Bitcoin are the perfect historical example. Why am I bringing all that up? I think there's going to be a monetary revolution. I think gold and silver and knock on wood, Bitcoin will be involved as well. And the monetary revolution is going to come into. You have to look at where the biggest pools of capital are in the U.S. and it's houses and 401(k)s, and they're going to do something with those. They're going to give people access to their money in their houses if they invest it domestically. I don't know how they're going to do it. They're also going to unlock 401(k)s to let them buy alternative assets, like private equity, but it's going to be gold and silver, I think. Uh, Not only is it going to be gold and silver, I don't know if it's going to be coins, but the industries are just revving up for something. But it's going to be the stablecoin product because it's taxable. Basically, they need to QSIP the gold demand. The demand is there. It's not going away. And they're going to securitize it and keep it in a wrapper and keep the metal domestically. It's the US's version of what Italy's doing. Show us your gold, then we won't tax you on it. The US is saying, you know what? You got a lot of money. We're going to let you put it into gold, but we need to keep watching it. I just think there's a revolution coming, not unlike what Reagan did in the 80s when he opened the doors for equities. I think the door is going to be open to precious metals. It's already been open to crypto. It's already there. So precious metals are next. They have to financialize it. Anyway, I'm Vince. Have a great day.